Burton Malkiel's famous book A Random Walk Down Wall Street provides an easy guidance for investors of all experience levels. Malcol contends that investing is primarily a game of chance and that a passive, long-term strategy emphasizing diversification and low-cost index funds is the most efficient method to accumulate wealth over time. This book is a must-read for anybody trying to thrive in the stock market, offering insights into the significance of having a clear investment strategy and the risks of allowing emotions to influence financial decisions. So what investment tips does Burton Malkiel offer? And why should you follow such advice? Well, let's get started. 1. Invest for the long term. Investing long-term is the best strategy since success in the stock market does not occur overnight, and investing is not a strategy for becoming wealthy quickly. The prices of stocks on the stock market are subject to wild fluctuations in the short term. The stock market, on the other hand, tends to go up over the long term, rewarding patient investors with increased profits. If you commit to an investment plan with a lengthy time horizon, you may steer clear of the short-term fluctuations in the market and instead focus on the bigger picture. If you give your assets more time to develop and expand, this may also help you achieve the financial goals you have set for yourself. Investing for the long term requires you to be patient, exercise self-control, and be dedicated to your investment strategy. It means avoiding the impulse to buy and sell based on fleeting market changes and being committed to your investing strategy, even when conditions are unfavorable, even though these conditions are likely to occur. 2. Diversify. Diversifying one's holdings such that they are dispersed throughout several different types of assets and fields of endeavor is one of the most important and effective investment strategies. The core principle is that even if one investment in your portfolio performs poorly, the overall impact of your portfolio may be mitigated if the performance of the other assets is strong. Two of the most effective methods for achieving diversification are to invest in a wide range of securities, such as stocks, bonds, and cash, and varied businesses such as the healthcare industry, the technology industry, or the energy industry. 3. Invest in low-cost index funds. One example of an index fund is the S&P 500 index fund, which attempts to simulate the results of a certain market index. A well-liked method of financial investment is buying shares in low-cost index funds, since these funds provide investors with access to a large portion of the market at reasonable costs. Traditional, actively managed mutual funds, on the other hand, have higher management costs and make individual investment decisions to outperform the market. These funds also charge investors more. According to the research findings, most actively managed funds cannot outperform the market over the long term. One of the reasons for this is the higher fees that actively managed funds charge. On the other hand, index funds offer a very cheap method of tracking the market's overall performance by allocating a portion of their portfolio to low-cost index funds. Investors increase their chance of profiting from broad diversification, reduce transaction costs, and a cheap investing strategy for the long run. 4. Don't try to beat the market. It is extremely difficult to outperform the market consistently, and even seasoned fund managers regularly fall short of accomplishing this goal. Many investors try to pick specific stocks or time the market to achieve better returns than the overall market. Conversely, these strategies almost always result in subpar performance and could even be hazardous. Studies have shown that passive investing strategies, such as buying low-cost index funds, may give long-term returns comparable to or even greater than active strategies. One of the key reasons for this is the stock market's exceptionally competitive and well-organized character. And because new information is immediately factored into stock prices, attempting to outsmart the market can be difficult, frustrating, and even pointless. By utilizing index funds rather than actively trading stocks or bonds, investors may participate in market activity while lowering their risk exposure and cutting costs. 5. Ignore market noise. Investing may be scary, particularly for people just beginning their journey into the world of finance. Don't worry about what other people are saying about the market. Ignoring the noise in the market is one of the most difficult challenges investors must overcome. The market may be unpredictable, and investors may be prompted to move rashly due to news articles. Market noise describes momentary movements and news articles that may induce investors to act impulsively. For instance, even if investors had every intention of holding onto their assets for the long term, a sudden drop in the stock market's value may drive them to succumb to fear and sell their holdings. This kind of knee-jerk reaction can harm an investor's portfolio and cause them to miss opportunities for long-term profits. Despite fleeting shifts in the market, if you maintain your commitment to your investment plan, you will be better able to ignore the noise in the market. This requires restraining oneself from acting impulsively in reaction to breaking news reports or unexpected swings in the market by buying or selling. Instead, investors should focus on accomplishing long-term goals and the foundation of their decisions on sound financial principles. Hey, just a quick reminder before we move on. Make sure to subscribe to my channel for all the latest financial planning and budgeting videos. Oh, and don't forget to check the description below for a link to my super helpful monthly budget trackers. Trust me, your wallet and your future self will thank you. Now let's get back to our topic. 6. Consider a buy and hold strategy. It is essential to remember that investing is a long-term game, even though it may be an exciting undertaking in and of itself. One of the keys to success is adopting a strategy known as buy and hold, in which you keep your assets for an extended period after making them. You can take advantage of the power of compounding if you use this method. When you buy and sell investments regularly, you put yourself at risk of experiencing a reduction in earnings due to fluctuations in the short-term value of the market, as well as the costs associated with trading. Obviously, this does not imply that you should continue to hold onto investments that are clearly performing poorly or no longer correspond to the investment goals you have established for yourself. It is essential to perform regular evaluations of your investment portfolio and to make any necessary adjustments. 7. Invest in what you understand. When investors are inexperienced with an investment, they have a greater propensity to make poor choices based on insufficient knowledge or market hype. This increases the likelihood that the investors will lose money. It is possible that this would result in significant losses, which would be counterproductive to their long-term investment goals. Investors need to prioritize educating themselves about the properties or commodities they are considering purchasing. They must understand the underlying risks that may include the potential for volatility, liquidity, and financial stability. They should also consider the history of the venture and the credentials of the people behind it. By sticking to investments they're comfortable with, investors may improve their ability to make intelligent decisions that are in keeping with the long-term financial goals they have set for themselves. 8. Pay attention to taxes. When making investments, it is essential to consider not only the possible returns of your assets, but also the future tax ramifications that may result from those returns. And because taxes can significantly impact the results of your investments, it is essential to make decisions that minimize their impact. One strategy for achieving this goal is to sit on your investments for an extended period. Because of this, capital gains taxes, which are charged on the profits gained from the sale of an investment, may be reduced. If you hold on to an investment for more than a year, you must pay long-term capital gains taxes. These taxes, often smaller than short-term capital gains taxes, are payable. 9. Avoid market timing. This is the strategy of attempting to foresee future moves in the market and buying or selling investments in accordance with such forecasts. Although it could appear to be a lucrative technique, maintaining success with it is quite difficult. One of the most significant challenges associated with market timing is the inability to predict swings in the market's short-term trajectory accurately. Even the most experienced analysts and investors have a difficult time providing accurate estimates. This indicates that market timers typically chase their tails, making poor judgments on when to buy and sell, and missing out on possible gains. Another disadvantage of market timing is that it might lead to illogical judgments being made about investments. When investors try to anticipate changes in the market, their attempts can cause them to become overly optimistic or pessimistic, which can cloud their judgment and lead them to making illogical decisions regarding their investments. Instead of trying to time the market, Malcol encourages investors to focus on developing a long-term investing strategy that uses a cheap, diversified portfolio of index funds. 10. Don't let emotions drive your investment decisions. Since prices are always fluctuating and short-term price movements are sometimes exaggerated in the news, investing in the stock market can cause investors to experience a roller coaster of mixed emotions. However, investors should avoid making decisions based on their feelings and instead adhere to their investment strategy to maximize their returns. This is especially important to remember if there is volatility or uncertainty in the market, since it may be tempting to sell stocks or make considerable alterations to one's portfolio. One option for avoiding the influence of one's feelings on one's financial choices is to have a well-defined investment plan already in place. This needs to have well-defined goals, a varied portfolio, and a perspective that is focused on the long term. Establishing a plan allows investors to avoid making hasty judgments based on the noise in the market or their feelings about the market. Another trait that investors should cultivate is patience, and they should avoid getting carried away by fleeting movements in the market. Now, as we wrap up this video, we'd like to leave you with a question to ponder. What is one specific step you will take to implement these tips into your investment strategy? Share your thoughts in the comments below. That's all, and remember to hit that like button and subscribe. See you in the next video.